All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Friday, everybody. Happy Jobs Day, everybody. Just moments ago, we got the non-farm payrolls report for the month of December. The single most important data point in all of finance at this point in time, guys. The jobs market is what determines the direction of everything right now. And it was a blowout jobs number. I mean, look, any way you look at it, it was fantastic. I mean, headline number, 256,000 jobs added. That is versus expectations of just 160,000. Not much in the way of revisions to prior months. Guys, this was a beat. This was a beat across the board. This was a big beat. I mean, not just better than expected. Absolutely demolished expectations here. The labor market is showing a very unusual sudden strengthening here. The unemployment rate falling to 4.1%, down from 4.2%. The participation rate was flat. It's not people retiring out of the job market, making the unemployment rate look better. Participation rate was unchanged here. This was really good. Some of the sectors we're seeing jobs added in, healthcare added 46,000, largely a function of our aging demographics in this country. Retail trade, though, plus 43,000 jobs. That really surprised me to see retail trade. These are seasonally adjusted numbers, mind you. So, it's not like, we would expect to be adding retail jobs in December. That's already accounted for in the math. So if we're adding 43,000, that's more than just a seasonal change there. Social assistance up 23,000. Leisure and hospitality up 43,000. People are traveling again. And we saw a little bit of that in the Delta Airlines numbers that came out this morning, showing some pretty good earnings from Delta. Government jobs up 33,000. Look, guys, this was a really good report. Now, you might be looking at that report, and then you go look at what the prices of some of these things are doing, and you're scratching your head saying, WTF, what's going on here? We got stocks are way down. We got the dollar is way up. We've got interest rates are way higher. What the heck is going on here? I thought this was good news. Why does it look like panic? The answer is, of course, the Fed. Fed. We don't have a free market. We don't have a fair market. We have a Fed market. And with a job market that is showing unusual strength to end the year, the market is now adjusting its expectations for further rate cuts from the Federal Reserve. And now the market is pretty much saying we'll be lucky if we get one interest rate cut in all of 2025. Look at how far we've come since September, when the Fed made a move that could be largely described as panic, with that scramble for the 50 basis point cut in September, and then another one after that, and then another one after that. And now we're saying, well, we didn't move in December. We're certainly not going to move in January now. We'll be lucky if we move once in all of this year. And of course, if the market is predicting less Fed rate cuts, less easy money available to pump up these asset prices. And so you're seeing interest rates rise and you're seeing assets sell off here. This is a pretty crazy morning going on. Now, look, guys, it's 9:05 a.m. right now as I'm doing this stream, and we get this on days with a lot of data points. You get the Monday morning quarterbacks come in around lunchtime or around 5 p.m. because everything is changing. We've seen some pretty crazy swings in the 25, 35 minutes since this report came out. So who knows what this is going to look like by close of business today. But right now, we've got stocks heading lower, dollar heading higher, interest rates heading higher. Some other stories we got going on this morning. Oil is sharply higher here, a couple of bucks up for the oil market here. Now, this is kind of interesting. I don't think this is any big, maybe the jobs report will add to some of the oil gains here, but it's largely got to do with Russia and with this shadow fleet. There's been a new round of sanctions have just gone into effect where they're targeting the insurance carriers that are insuring the ships of this Russian shadow fleet, the tankers that are moving oil around the world in violation of the sanctions that we put on following the invasion of Ukraine. Now, when you mess with the insurance, all of a sudden people are less willing to put their cargoes on the boat, and also you can't traverse certain canals or go under certain bridges if you don't have insurance. So it's really limiting what this Russian shadow fleet can do. And because of that, we got a story in Bloomberg that says China and India are actually buying more oil from the Middle East and Africa now. So it's bidding up those Brent crude futures, taking WTI higher with it. So we've got sharply oil prices here this morning as well. Also, guys, these wildfires in LA, it's been 2 days since we did a live stream. when we left off, the wildfire story was just kind of getting going, but it was already showing signs like, hey, this is going to be the real deal. These winds aren't going to let up, and it's very dry over there. As it stands right now, more than 10,000 structures have been destroyed by these fires. We've got damages are currently estimated to be in the ballpark of 135 to 150 billion. That puts it roughly on par with Hurricane Harvey as for economic damages. And the fire is largely still uncontained. And now we're hearing stories about arsonists, firebugs all over LA who are adding to the problems. Just an absolute mess over in LA. And I just got to say, guys, it's bringing out the worst in people all over the country. I can't stand this. I'm going to soapbox for a minute here, but whatever happened to the bumper sticker that said shit happens? Do you guys remember that? Like back in the 70s and the 80s when shit used to happen? That doesn't happen, and shit doesn't happen anymore. Now we have Mother Earth gets angry and everything is because climate, or the countryside is burning down because of DEI hires. Like there's no longer just accidents, just natural disasters. Everybody has to take advantage of some tragedy of anything for some pre-existing political leaning to score cheap political points. And the bickering, and people are doing things like filming firefighters and like shouting shit at them while they're working. Like these guys have been running ragged for 3 days straight. Fighting a wildland fire is unbelievably exhausting work. You're given a shovel and a chainsaw and say, go put out a 10,000 acre fire, go hike up a mountain before you do that. And these Karens are filming them, like bad mouthing them. Like, look, guys, you're just political looters. That's really all you're doing. These people who are like bad mouthing firefighters. And, look, there's plenty of time after the dust settles from this to criticize preparedness and government response. Sure, you want to do that after the fact, that's fine. But don't drag the freaking firefighters into it. I've seen some really awful stuff going on X and some of the other social media platforms around this, guys. Shit happens, all right? It's not because of climate change. It's not because of freaking gay marriage. It just happens. Can we just get back to shit happens sometimes? All right, that's all I got to say about that. Also going on this morning, Constellation is officially buying Calpine Energy. That's something I talked about yesterday in my video about the AI bubble, nuclear and natural gas, and where is the power to power these data centers going to come from. I did mention how that Calpine deal was rumored a few days ago. Well, it's official this morning. Constellation Energy is buying Calpine for $16.4 billion in cash and stock, and they're also assuming $12.7 billion worth of Calpine's debt. So you're looking at a total purchase price of about $26.6 billion for that deal. Constellation secures more natural gas generation assets to try to power the AI bubble. We got a big earnings beat from Delta Airlines this morning as people shift towards more luxury travel. This is very interesting. Delta Airlines is ripping because of the high price, the first class, the upgrades. Meanwhile, you got like Spirit and JetBlue, all the budget carriers are going bankrupt. You can see the bifurcation of the economy in plain view there, with the luxury guys doing great while the discount guys are struggling for survival. You also got Walgreens Boots Alliance, ticker WBA. They are ripping higher this morning despite posting a wider than expected loss, because there's a few signs of life in that earnings report, and the pharmacy stocks have been just beaten the heck in the whole second half of last year. So a slight glimmer of good news in that Walgreens earnings report, and that stock is ripping double digits. It was up 17% the last time I looked. Who knows what it's going to be by the time we get to the ticker. And we got some worrying news about natural gas storage in the UK this morning. Colder than expected winter. Could the UK have a long overdue reckoning for their energy policy coming here? Now, look, guys, Europe kind of got off easy over the last 2 years. Since the Russian invasion and since the pipelines went boom and since the gas stopped flowing, we've had a couple of mild winters. And so Europe may have been lulled into a false sense of security. Well, I don't know if you guys have looked out the window or listened to the wind lately, but Mother Nature's pissed this winter. This winter sucks so far. It has not been mild, at least not where I'm at, and I don't think it's any different in Europe. So we're starting to see that natural gas storage level drop precipitously. And it's only January. We got a long winter ahead of us, guys. We got a lot to talk about this morning, so why don't we shrink my big melon of a head and let's see what's going on in this market. Hey, don't forget that like button or that subscribe button so you can come have your coffee with the melon heads, because we do this every morning, so long as markets are open, that is. Right now, the S&P 500 is down 44 points, about 0.75%. You can see all of those losses came in the 5 minutes following that jobs report. Again, guys, we're back to this good news is bad news because Fed kind of market here where we had a really good jobs report. Hey, pay is rising, unemployment is falling. This is good news, and stocks are selling off because it means less easy money from the Fed. Dow, same story, down 250 points or about 0.6%. The Dow's actually clawing back a little bit of those losses. It dropped about 350 points instantaneously on that jobs report. Since then, it's picked back about 100 of those. And the NASDAQ is leading the way lower, down 177 points or 0.8% lower, also clawing back some of those losses as time goes on. Again, guys, it's going to be a volatile day. Jobs reports are very important data points. The algorithms are in charge right now. We'll see what happens after the opening bell. But right now, it's looking pretty bad. Check out the dollar here, guys. 109.61, up 44 basis points. Again, all in the aftermath of that jobs report. Why a stronger dollar? Because fewer Fed rate cuts, maybe less quantitative easing, or we'll say perhaps quantitative tightening will continue for longer here. That means dollars getting more scarce. And of course, the Dixie goes higher on that news. This is also putting downward pressure on asset prices this morning. Are we going to see a 110 handle on the Dixie today? It's possible. We could see it. Right now, it's heading in the other direction, though. And interest rates are sharply higher, especially on the long end of the curve here. The 10-year has been all over the place this morning. The 30-year yield right now is at 4.981. That is up 6 basis points. The 10-year, 4.747. That's almost 7 basis points higher. At one point, we were 13 points higher. I mean, the 10-year has been really volatile here. The 2-year, 4.354. That's up 9 points. The 2-month is at 4.328. That's up 1.5 points. The 2-year was at 4.354. That's up 9 points. And the 1 month is at 4.319. Up a point and change. Look, guys, interest rates, again, everything's moving right now. Everything is volatile. The market is still digesting what just happened. The algorithms are arm wrestling with each other. So I typically sit out while this is going on. Now, we've got gold is showing surprising strength here with a sharply stronger dollar and interest rates moving higher. You'd think gold would be selling off here. And the initial reaction from gold was to take a few steps down. But now we're clawing that back. Spot gold is up $13, $2,683. That's 0.5% higher. We've got spot silver is at $30.48, firmly above that 30 handle. That's 36 cents higher this morning, 1.25% higher. So gold and silver are doing remarkably well, all things considered here. We've got copper is up 0.9%. Platinum is up 1.25%. Palladium is up almost 4%. And look at crude oil here. Big numbers from West Texas Intermediate here for February delivery. $76.89. That is higher by $3 this morning. 4% higher for WTI crude. Let's take a look at the WTI chart. You can kind of see it here. These are daily candles. Here, let's go back to the beginning of 2024 and look at this move here this morning. Big old middle finger from the Russians, it looks like. That's what we are seeing in the oil markets here. Back above the 200-day moving average. We haven't seen the 200-day average since October of last year. Big move higher in oil. Will it last? I don't know. But let's talk about what's going on here. This one in Bloomberg this morning. Oil sanctions concern spurs Asian buyers to seek alternatives. Refiners in China and India are taking more Middle East and African oil. Few and costly offers and logistical risks affect sensitive flows. Oil refiners in India and China have increased crude purchases from the Middle East and other regions amid concern that further restrictions on imports from Russian and Iran may crimp access to supplies. This week, 2 Indian state refiners bought up to 6 million barrels of Oman and Abu Dhabi's Murban crude for prompt loading in February, according to traders, who attributed the purchase to a shortfall of Russian spot cargoes. Meanwhile, Chinese buyers, including state-owned Unipec as well as private refiners Shandong, lifted imports of Angolan oil. Traders also said a local processor picked up prompt supplies of Abu Dhabi oil. The surge in buying interest from Indian and Chinese buyers has stemmed not only from fewer and pricier offers from the Urals, Espo, and Iranian light crude, but also from fears of more sanctions on tankers used to transport these cargoes and the implications on refiners and others in the supply chain, traders said. This latest batch of sanctions, it's going after the insurance carriers for that Russian shadow fleet. No insurance means no cargo, means no passage through those vital bottlenecks. And so the big buyers of Russian crude, China and India, are looking elsewhere, and that is bidding up the price of WTI and Brent this morning. Looking over at Bitcoin, we've got Bitcoin's actually also holding up pretty well here, $94,278. It's been a little bit volatile since that jobs report came out. I would have expected this to be moving a little bit lower on the adjusting Fed news, but it's done okay here. Now, Bitcoin had a really bad couple of days to start the week here, Tuesday, Wednesday, and Thursday. I mean, we went from a high of about 102,000 to as low as, 91,200 at one point. Now, I did find one story that could partially explain this recent sell-off in Bitcoin here. DOJ cleared to sell $6.5 billion of Bitcoin seized from Silk Road. Remember Silk Road? I mean, that's going way back. What was that, like 2012 that Silk Road went down? Well, the government has been sitting on this 69,370 Bitcoin that was seized from Silk Road, and the FBI still has it. The Department of Justice still has it. They haven't sold it yet. Now, the judge cleared them to sell it. There was some guys were doing some on-chain checks on the wallet addresses where this Bitcoin resides, and it's still there. But it's possible the fact that the judge cleared this sale to happen, you've got some traders are front-running that DOJ sale, anticipating the sell-off. And so that could explain the move we saw in Bitcoin yesterday. But as of a few hours ago, at least, that DOJ Bitcoin hadn't moved. Let me just say, if we're thinking about starting this strategic Bitcoin reserve, then maybe we shouldn't be dumping this 69,370 Bitcoin on the open market. I mean, the government kind of already has a strategic Bitcoin reserve, don't they? If the DOJ is sitting on this, maybe we just move it from the DOJ over to, I don't know, who's it going to be, the Treasury or the Fed, whoever's going to house this Bitcoin reserve. Maybe we just send it over there instead of selling it and then buying it back later at a higher price. But then again, we are talking about the government here, so maybe we just move on from that. Let's talk about this jobs report, though, guys. Really good numbers this morning. Really good. Non-farm payrolls in the United States increased by 256,000 in December of 2024. Let's refresh this, see if we get some more color here. That's following a downwardly revised 212,000 in November. So we did give back a couple of thousand jobs from that November report. Once again, though, beating market forecasts for 160,000. Figures from October were also adjusted, resulting in a combined downward revision of 8,000 for October and November. 8,000 in downward revisions, guys, that's a rounding error, not the big downward revisions we've been used to for most of 2024. In December, employment trended up in healthcare by 46,000, government by 33,000, social assistance 23,000, retail trade added 43,000 jobs, mostly due to clothing, accessories, shoes, and jewelry. 23,000. What else we have here? Meanwhile, employment declined by 13,000 in manufacturing. That's got to be autos, and that's in that category. I'm guessing drove most of that. Let's see. Considering full 2024, payroll employment rose by 2.2 million in 2024, an average monthly gain of 186,000. So there's your chart there showing your 256,000 jobs added, your downwardly revised 212 from November. October, barely in positive territory of 43,000. But guys, this was a big beat here. I mean, just absolutely blew away expectations. Now, I just want to, let's go to this other one here. Let's talk unemployment rate. Here's the unemployment rate chart. We ticked down from 4.2% to 4.1%, back to where we were in October and September. So, hey, if we take a look at the high from July at 4.3, guys, it really does look like a downtrend has started in the unemployment rate. Now, if that's the case, then yes, the market is going to adjust their expectations for what the Fed is going to do, because the only reason for the Fed to cut is to try to stimulate employment, or at least that's the cover story that they give us. Really, the reason the Fed cuts is because they're trying to juice asset prices higher, but I digress. Take a look at expectations here for Fed rate cuts. This is CME futures for January 29th. This is the next time the Fed is meeting. Right now, the market is saying 97% chance. Let's refresh this because it may have changed in the last few minutes. 97.3% likelihood that the Fed does nothing in January. Just a two and change percent chance that we get a 25 basis point cut in January. So the Fed is not moving later this month. Let's look at March. Still 72% likelihood of no cuts by March. Only a 27% chance of a 25 basis point cut. By May, they're still saying 58% chance of no move, even by May. We don't get until June until we see 400 to 425 becoming the most likely outcome at 43%. So as of right now, it looks like we're not going to get our first rate cut until June, maybe July. And if you look at the end of the year projections for December of this year, the most likely outcome at 39% is 400 to 425 basis points for the overnight rate. That is one cut is being priced in for this market from now through the end of the year. I mean, think about how far we've come in just 3-4 months since September, since that panic of 50 basis points. And now we're sitting here saying for the remainder of the year, we'll be lucky to get one. So the market really shifting their expectations here, guys, versus where we were just a couple of weeks ago. That explains the higher rates. That explains the lower stock prices this morning. All right, we got a couple other stories. Let's talk about this LA fire here. LA fire crews make strides in fighting blazes as the toll climbs. The Kenneth Blaze, apparently they're naming these things now. The fire's name is Kenny. Okay. The Kenneth Blaze that flared up on Thursday is only about 35% contained. Threats are likely to rise again early next week as the winds rise. And guys, the video of this fire, looking at how these winds are whipping. I mean, Mish sent me a video and he used the description. Palm trees look like flamethrowers in these winds. A guy with a hose just has no chance against this. I mean, you can contain a fire like this. You can cut a fire break and you can wait till it exhausts itself and burn itself out. And then the wind picks up an ember and it drops at 10 miles behind you and the whole thing starts up all over again. And you got to start from scratch. This is really a losing battle here. Firefighters are making some progress on controlling the deadly blazes that have scorched Los Angeles as the toll of destruction rises with entire neighborhoods reduced to ash. 4 out of the 5 major fires roaring across the region showed some signs of being contained as of early Friday. The Kenneth fire that broke out and expanded rapidly on Thursday is now about 35% in check. However, the largest blazes are still burning largely uncontrolled. The scale of the devastation is also becoming clearer. At least 10 people have died due to the fires, the Associated Press reported, citing the county coroner's office. As many as 10,000 structures, including homes and businesses, have likely been damaged or destroyed. About 180,000 residents have been forced to flee. The fires, which have razed swaths of America's second largest city, have the potential to become one of the costliest disasters in modern U.S. history. AccuWeather has estimated the economic losses at $135 to $150 billion. So it's already double the damages from Superstorm Sandy. It's roughly in the ballpark of a Hurricane Harvey as far as the economic cost. And again, look at some of these numbers. Most of these fires are uncontained. One of them is about 35% contained. And now we're seeing stories about arsonists all over LA. This is going to get worse before it gets better, guys. And it's not going to change until Mother Nature lets up with the winds. Otherwise, these guys, all they can really do is slow this thing down. Let's talk about this merger. Constellation Energy to acquire Calpine for $16.4 billion. We talked about the rumor of this deal at the end of my video yesterday about the AI bubble and their power needs, and it looks like this has been confirmed now. Constellation agreed to acquire closely held Calpine Corp for $16.4 billion to add scores of power generation assets across the U.S. as the nation's electricity demand is forecast to surge. Constellation will pay a mix of cash and stock, the company said on Friday in a statement. Constellation will also assume about $12.7 billion of Calpine's net debt. Its shares rose 5% in pre-market trading in New York. The takeover would be one of the largest for a U.S. power generation company and crystallize a substantial return for Calpine shareholders, Energy Capital Partners, Canada Pension Plan Investments, and Access Industries, who together took the company private for $5.5 billion in 2018. Heck of a deal for them, $5.5 billion up to what, 16.4 in cash and stock they're getting. Decent return for the private equity funds and the pension plans that bought Calpine. Now take a look at Constellation stock. It is ripping this morning, up 13.6% ahead of the opening bell. 15.6%. Now it fell about 10% earlier this week on the rumor of this deal. Now it's gotten all of that back and then some, currently trading at $281.62. And I mentioned this in the video last night, guys. This is really all about natural gas. I was looking at what Calpine's generation assets are. They own a mix of cogeneration, combined cycle, and straight-up natural gas turbines, largely in California, Texas, and the Northeast. Constellation, the biggest operator, the second biggest operator of nuclear power plants in the United States. They're among the biggest in the world, and they are buying up natural gas generating assets like crazy. Because I talked about this in the video. Realistically, the only power source that can be deployed in any reasonable amount of time to power these data centers that they're building like crazy is natural gas. There's a lot of popular talking points about nuclear power, about how all these new reactors are going to get built by 2027 and power all these data centers. It's not going to happen, guys, not as long as the NRC is operating the way they are. I went into more detail about that in that video last night. Check that one out if you want. Shameless self-promotion. We also got Delta Airlines stock is ripping this morning. Delta Outlook tops estimates as CEO expects 2025 to be the airline's best financial year in our history. Even as other airlines are going bankrupt, the premium carriers are doing great. Delta Airlines' first quarter outlook on Friday topped analysts' expectations as the carrier forecast strong travel demand to start the year, which CEO Ed Bastian said will likely be the carrier's best ever. Delta said it expects to generate more than $4 billion in free cash this year, up 18% from 2024, and in the midpoint of its annual target of between $3 and $5 billion. For the full year, it expects annual adjusted earnings of more than $7.35 a share. The Atlanta-based airline is the first major U.S. airline to report earnings this quarter. Carriers have enjoyed strong post-pandemic travel demand, which analysts said is likely to continue this year with a few deals along the way for consumers. Delta has said it's been capitalizing on a trend towards premium travel as more customers shell out for roomier seats or rewards credit cards. I don't want to say as more customers shell out. I think I would say as wealthier customers shell out, because a certain segment of the population is doing great and everybody else is doing lousy. And, well, Delta's customers are the ones who are doing great, and hence Delta stock up 5.2%, trading at $64.60 this morning. That's higher by about $3.10. Good morning for Delta shareholders. Also, good morning for Walgreens shareholders. Walgreens stocks jumped 10% as troubled drugstore chain shows early progress with a turnaround. This is a stock that's been beaten down, and it is having one heck of a relief rally off of this earnings report. Even though there was plenty of bad news in this report, that little bit of good news was enough to send the stock higher. Walgreens Boots Alliance stock jumped 10% early Friday after the troubled drugstore chain posted another loss, but blew past estimates on an adjusted basis and said it would continue to work on a turnaround. The Deerfield, Illinois-based company had a loss of $265 million or 31 cents a share. That's far wider than the $67 million or 8 cents a share in the year earlier period. But adjusted for one-time items, the company actually had earnings per share of 51 cents ahead of the 38-cent consensus. Sales actually rose 7.5% to $39.5 billion, and were also ahead of the $37.4 billion consensus. The results reflect our disciplined execution against our 2025 priorities, stabilizing the retail pharmacy by optimizing our footprint, controlling operating costs, improving cash flow, and continuing to address reimbursement models, CEO Tim Wentworth said in prepared remarks. Now look at Walgreens stock here, ripping higher this morning, 15% ahead of the opening bell, trading at $10.60. That's higher by $1.38. Now let's look at a one-year chart of Walgreens, however. Let's see, Yahoo Finance is a little slow to update here. It's not really working. Here we go. 5 years, you can see. This stock has been pretty much going down constantly for the last 5 years. It was down about 50% in 2024. So we're getting some of that back this morning. This is pretty much just a relief rally. Last one I want to talk about, guys. This is one worth keeping an eye on, especially if Mother Nature doesn't let up. Centrica warns UK gas reserves are concerningly low after a freeze. Now, we've been here before and we've avoided the worst possible outcome, but once again, gas and energy worries in Europe. Centrica says that the UK's gas reserves are at concerningly low levels as freezing temperatures grip the country, boosting demand for heating. The owner of British Gas said the colder than usual conditions in the UK, combined with the end of Russian gas pipeline supplies through Ukraine, has meant that gas inventory levels in the UK have fallen. As of Thursday, UK gas storage sites are 26% lower, or around half full, than they were at the same point last year, leaving the country less than a week of gas demand to fall back on, Centrica said in a statement on Friday. Now, there's some optimism and some pessimism in that paragraph there. First of all, they're saying, okay, they're around half full. Optimistic appraisal of the situation. but 26% lower than a year ago. That's pretty worrying because we're not that deep into winter here, guys. It's still the first half of January. We got the coldest months are still ahead of us. Now, at the same time, when they're saying, oh, we've only got a week of gas demand to fall back on, all right, that is an alarmist statement there because that week of gas flow, that means if all production and all pipeline flow were to be cut off 100% tomorrow, we would run out of gas in a week. But that's not going to happen. They're not going to cut off all the gas flow tomorrow. All right, that just means their reserves are getting low. The burn rate is worrying. There needs to be a slowdown in the burn rate is pretty much what they're saying here. Now, look, the UK and Europe as a whole, their energy policy has been run by imbecilic children for decades. You know, lo and behold, it turns out there's consequences. When you take an angry, autistic 16-year-old girl and you put her in charge of energy policy for an entire continent, the world's third largest economy, there's problems. You know, maybe putting Greta in charge of energy policy for billions of people was not a good idea in hindsight. Maybe we want to go back and review that decision. In hindsight, maybe it wasn't so intelligent. And now people can't afford to heat their homes. This is going to result in higher prices. They're going to raise prices until the demand weakens unless people decide, yeah, I'd rather sleep with a sweater on than pay these bills. It's probably what it's going to take to get the UK through winter here. Look, sooner or later, the adults need to retake the conversation on energy. It's happening here in the States right now. You know, this pipe dream of wind and solar, it's finally going away. We're finally coming to our senses about nuclear power. I think they're being overly optimistic about nuclear. I think the regulators need to get the hell out of the way before we can actually get those plants built. That being said, I still believe in nuclear power. We're expanding gas again. So, you know, the adults are slowly taking over an energy policy as the pendulum begins to swing back the other way. But Europe still, they got a long way to go on that continent. They've really done a lot of damage. And I just want to say thank you very much to Gordon Guano. Welcome to the Melonheads. Gordon, a new member. I'm sure you get this a lot, Gordon, but that name, it sounds batshit crazy, doesn't it? Sorry, I know I took a cheap shot at you. But thank you so much, Gordon, for supporting the channel. And welcome to the Melonheads, sir. And hey, here's Gordon again. Thanks, Gordon, for the super chat as well. He says, just learned about ETFs offering weekly dividends based on trading zero DTE options. Oh, my God. What is this malarkey? On stocks like MicroStrategy or NVIDIA, strong, healthy market and not a degenerate casino, right? Well said, sir. I don't think I can elaborate on not a degenerate casino. Wouldn't touch it with a 12-foot Swede. Yes, sir. Your 12-foot Swede exceeds even my 10-foot pole, neither of which are touching ETFs offering dividends on zero DTE options. So a derivative of single stock zero data expiration options. Okay. I mean, it seems like this is a contest to see how fast we can lose money. Just go buy $1 billion worth of lottery tickets. Like maybe you could burn through money faster. I share your concern. Look, there's a lot of people are out there picking up pennies in front of that steamroller, making money on these zero DTE options. Guys, all you're really doing is making bets on volatility. You're shorting vol. And when you short vol, trade works until it doesn't. And ask Joe Brown how that trade works right up until it doesn't. And then when that doesn't gets here, what does it look like? I mean, Joe has been very candid about his experience with shorting volatility and what he went through. I mean, it's a nightmare story. Just be careful, guys. Look, when Fartcoin is ripping to multi-billion-dollar valuations, obviously something is very wrong. So just be careful. Thanks again, Gordon, for supporting the channel. I also appreciate the colorful language, sir. And thank you to my buddy Julius Miami. Hey, Jules, he says, excellent morning rant, Jack. Bravo. Thank you so much, Jules. I appreciate the support of the channel and the kind words, sir. And Lisa K is here as well. Lisa, thank you for supporting the channel. Do you think some of the motivation for the Fed lowering interest rates is related to old debt that needs refis in 2025, approximately $3 trillion? So this story, I've seen a lot of iterations of this story over the last couple of years. At any given time, there's always a large amount of debt that needs refinancing in the United States. So I've seen a lot of versions of it. Now, this year in particular, it's pretty high because one of the things that Janet Yellen did during her tenure at Treasury, she had an over-reliance on T-bill issuance. T-bills is the stuff at the short end of the yield curve, the 1 month, the 3 months, the 6 month, right? The Treasury bills. She issued a lot of short-term debt. And, well, the problem with short-term debt is it expires in the short term. So all of that short-term debt that Janet Yellen issued last year all needs to be refinanced this year. And the responsible thing to do would be to refinance that more evenly across the entire yield curve, not just short term, but also long term. So when we issue more long term debt to refinance Janet Yellen's short term debt, that's going to add more treasury supply on the long end of the yield curve. That's going to send those prices on the long end lower, and that's going to send those interest rates on the long end higher. In other words, it's going to put upward pressure on interest rates for things like mortgages, auto loans, credit cards, all of which are based on the 10-year treasury, that long-term debt. So I think the biggest worry here with the refi of debt is the fact that it's short-term, that's going to be moved out on the yield curve. That could potentially send those rates higher, and that could have ripple effects in the housing market and the auto market, both of which are already struggling under existing rates. So I don't think there's like a big default risk or anything like, right? I don't think, we're going to have the debt ceiling circus again. That's all coming back. But really, I think the surge of issuance on the long end of the yield curve is the real concern that you need to be watching out for there. And we're seeing those yields move higher this morning. Thanks again, Lisa K, for supporting the channel. And Uncle Fedster, thank you for doing so as well. He says, happy Friday, Jack. California is a beautiful state. I hear the weather's nice. But with insurance companies leaving in fair prices, fair, I believe, correct me if I'm wrong, Fedster, but that fair is like the state-run, like last resort insurance program in California, right? But with companies leaving and fair prices, which are very expensive, it's a relief not to own a home in California. Now, look, Fedster, all the scenarios you're describing here, insurance companies leaving because they won't insure these homes because of natural disaster risk and the high price of these homes. Insurance being unaffordable in the state program. You know what the solution to all of these things is? It's not more government subsidies. It's not more programs. It's not more climate battling bills. Lower home prices will solve all of these problems. All right. If there is a significant risk that your house is going to burn down in a wildfire, then maybe, just maybe, we're talking crazy here, just maybe that house shouldn't be worth $3.5–4 million. Maybe the banks shouldn't be willing to underwrite ridiculously bloated jumbo mortgages for these properties if Mother Nature's going to come along and turn it to ash and nobody's willing to insure it. Just maybe the solution here is lower prices. I just throw them out there. You guys do what you want with them. That being said, I'm sure there's going to be some relief bill that tries to pass all these losses on to the taxpayers, on to everybody else. And hey, why shouldn't poor people in flyover country subsidize the rebuilding of multi-million-dollar mansions in Malibu? That seems like a perfectly reasonable thing to do, right? Or maybe we just let the values correct to fair market prices. I just throw them out there. Thank you, Uncle Fester, for supporting the channel, sir. And Eduardo Garcia, thank you, sir. Tinfoil hat time. Okay. Merchandising. Thank you, Yogurt. Tinfoil hat time. Job report equals great economy given to Trump. I don't think it's a great economy given to Trump. I haven't had a chance to really dissect the jobs numbers yet. I haven't gone into the tables and the attachments. Are they full-time? Are they part-time? Are they multiple job holders? All right. When you have more time, and it's very time-consuming, that analysis. It's possible there is some little landmines hiding in the data that says this jobs report isn't as good as it seems. And I usually find something like that. That being said, the headline number was really good here. Minimal revisions to prior months' numbers. I'm a little hesitant to chalk this one up to just government manipulating the data. I'm a little hesitant to do that. And you guys know me. I mean, I'm known to do that from time to time. We did see a big surge in JOLTS job openings. So a surge of openings could be indicative of a stronger labor market. So, I mean, there's some other data surrounding this jobs report that could partially explain this blowout jobs number. So I don't want to just be like the government is lying and dismiss the number. And I am known to do that from time to time. And I'll play that card if I feel it's appropriate here. But I haven't seen anything yet that makes me want to question this headline number. All right. And if I do see that, I will, of course, let you guys know. But right now it looks legit. And based on what the headline number is telling us, the market reaction seems legit as well. The market is saying, well, if we're putting up numbers like this, the Fed ain't going to cut. So far, I'm going to go out on a limb here, and I'm going to say this is a legit report that there's no political motivations. But again, if it changes, I'll let you guys know. Thank you, Eduardo. Appreciate the super chat and the support of the channel. And thank you guys for having your coffee with the Melonheads this morning. I appreciate that very much. Shout out to my magnanimous Melonheads on Patreon and YouTube. Thank you guys for everything you do for the channel. Looking forward to talking to you guys at 2 p.m. Eastern Time on our weekly get-together on Zoom today. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big. Oh, and don't forget that like button and the subscribe thing on the way out. All that good stuff. See you guys.